Warren Buffett's Top 50 Balance Sheet Secrets, my friends. Welcome. Let's talk balance sheets, the language of business. Just like I pore over these financial statements, you too can unlock the secrets to identifying promising companies. Over the years, I've shared my thinking in letters to Berkshire Hathaway shareholders. Now, I'm distilling 50 key insights into this program. These points, drawn from decades of experience, will equip you to think like an investor, just like me. Tangible book value. What is the company really worth? Look beyond the numbers, see the real assets. Debt management, can they handle the burden? Too much debt? A red flag, proceed with caution. Return on equity, the efficiency engine. High ROE consistently, now that's impressive. Chapter 4, cash flow, the lifeblood of business. Strong cash flow, like a river, keeps flowing. Chapter 5, durable competitive advantage, the moat. A wide moat protects, ensures long-term success. Chapter 6, management quality, captains of the ship. Trustworthy, competent leaders, essential for success. Chapter 7, long-term perspective, planting seeds for the future. Think long-term, like planting an oak tree. Patience is key. Chapter 8, consistent operating expenses, a sign of discipline. Predictable expenses, a well-managed ship, my friend. Chapter 9, deferred revenue, future income, already booked. Money in the bank, even before the work is done. Higher margins, a sign of pricing power, good business. Inventory moving quickly, that's a good sign. Getting paid promptly, a sign of strong operations. Chapter 13, can they pay their bills? The current ratio tells us. Chapter 14, even stricter, can they cover debts without selling inventory? Chapter 15, can they comfortably pay their interest expense? Chapter 16, dividend payout ratio, sharing the profits. Dividends, a good sign, but are they sustainable? Chapter 17, earnings retention ratio, reinvesting for growth. Reinvesting profits, a sign of ambition, future growth. Chapter 18, free cash flow, the fuel for growth. Cash is king, free cash flow even more so. Chapter 19, capital expenditures, investing for the future. Spending on equipment is often a sign of expansion, and it's generally a good sign. Chapter 20, share buybacks, management's vote of confidence. Buying back shares, that usually means they believe the stock is undervalued. Chapter 21, insider ownership, skin in the game. Management owning shares. This means their interests are aligned with those of the shareholders. Chapter 22, economic moat, a durable competitive advantage. Like a castle, a strong moat protects against competition. Chapter 23, competitive landscape, know your rivals. Who are the competitors? How fierce is the competition? Chapter 24, market share, a slice of the pie, dominating the market, a sign of strength and influence. Chapter 25, revenue growth, the top line, sales increasing, a healthy sign of a growing business. Chapter 26, earnings growth, the bottom line, profits increasing, that's what we like to see. Chapter 27, price to earnings ratio. Is it overvalued? A high PE ratio? The market is optimistic, be cautious. Chapter 28, price to book ratio, assets at a discount. A low PB ratio, the market might be undervaluing the assets. Chapter 29, price to sales ratio, revenue generation. Another way to assess valuation, especially for young companies. Title: Dividend Yield, income from your investment, a steady stream of dividends, music to an investor's ears. Are those dividends sustainable? The payout ratio tells us. How profitable are their core operations? The margin reveals all. The bottom line, after all expenses, how much profit remains? Return on assets, or ROA, measures asset efficiency. How effectively are they using their assets to generate profit? This is crucial for understanding asset utilization, return on investment, and various financial ratios. Return on invested capital, or ROIC, is all about investment returns. It measures the return on all invested capital, a key metric for evaluating capital allocation, investment efficiency, and value creation. Asset turnover focuses on generating sales from assets. How efficiently are they using assets to generate revenue? This is essential for analyzing asset management, sales efficiency, and overall operational performance. Equity multiplier, the power of leverage. How much are they using debt to finance their assets? Debt to equity ratio, balancing debt and equity. A high debt to equity ratio could be a sign of risk. Chapter 39. Interest expense, the cost of borrowing. Keep an eye on interest expense, especially in a rising rate environment. Understanding a company's effective tax rate is crucial. Don't be fooled by these non-cash expenses. They impact value. Brand value, intellectual property, these are valuable assets. Chapter 43. Companies investing in research and development are focused on the long term. Chapter 44. Keeping an eye on overhead is key to efficient operations. Chapter 45. The cash generated from their core business, a vital sign. Chapter 46. Investing cash flow, investing for growth. Are they investing in their future? The cash flow tells us. Chapter 47. Financing cash flow, managing the capital structure. How are they financing their operations and growth? Debt issuance, equity offerings, dividend payments. Net change in cash, the cash flow bottom line, the overall change in their cash position, a key indicator. Chapter 49. Total assets, the size of the ship, the sum of all their assets, a measure of their size and scope. Chapter 50. Total liabilities, the debt burden. Understanding their debt obligations is crucial for investors. Until next time, keep learning. As we conclude this deep dive into balance sheet analysis, remember that these 50 points are just the beginning. Investing, like life, is a journey of continuous learning. Take these insights, apply them to your own analysis, and never stop seeking knowledge. Remember, the best investment you can make is in yourself.